So you want to sell cover calls, but you don't have 100 shares of a stock. Maybe you're thinking something like Apple, but you don't have $15,000 to drop on a single trade. And that's okay. Luckily for you, we have the poor man's cover call where you don't need to own any shares at all, and you can still sell calls against whatever stock you want. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about the poor man's cover call. So to break this video down for you, first we're going to talk about the basics behind the strategy and how exactly it works. Then I'm going to highlight the risks that are associated with it, because with any trading strategy, you can always lose money. After that, I'm going to take you through a real example using Robinhood. And finally, at the end of this video, I'm going to give you a few stocks that you might want to consider for this strategy. But before we get into it, if you learn anything out of this video, or if you just enjoy it, make sure to leave a like down below. And if you have any questions, leave them down in the comments. Thanks. With a regular cover call, in order to cover your trade, you're going to have 100 shares of your stock to sell at the strike price that you chose. But with a poor man's cover call, you don't need any shares at all. And this is because you're going to buy a call option first, and that call option gives you the rights to buy 100 shares of your stock at the strike price that you choose. And the great thing about this is you don't have to. Since you have the right, you're not obligated to buy 100 shares of the stock at that strike price. Whenever you sell a call option, though, like a poor man's cover call, you are obligated to sell 100 shares of your stock at your strike price if the option expires in the money, and at any time before the expiration date if the buyer decides to exercise early on you. But the goal of this strategy is to have the option that you're selling in your poor man's cover call expire out of the money. That way you get to collect all of the credit and you don't have to sell the 100 shares at whatever strike price that you sell. If the option expires out of the money, then you're not going to get assigned to sell 100 shares of the stock, and that means you get to keep the option that you bought. So you're going to start the strategy out by first buying a call option with over 6 months until the expiration date to give yourself plenty of time for the stock to move in the direction that you're predicting, which is usually going to be up with the poor man's cover call. And a good way to put the odds in your favor is by going with an in-the-money call for the option that you're buying. A good way to judge if an option is going to stay in the money, though, is going to be by using delta values. Now, I like to stick to delta values of 0.7 or higher, and this just means that there is a 70% chance or greater that the option is going to expire in the money. Now, this is just an estimate of the percent chance of your option expiring in the money, and it can change any time before the expiration. Once you buy that call, though, you're taking on a position for the stock, basically owning 100 shares like we talked about earlier. And since you theoretically own 100 shares of your stock, this means that you can sell call options against the call that you bought. For these options, in order to make the most amount of profit consistently, you want to sell poor man's cover calls that are out of the money. This means that there is a less chance that they'll become in the money to where you'll get assigned on the call that you're selling. That way you can continue to keep holding onto the option that you bought. And a good way to judge if your option is going to expire in the money or out of the money, in this case you want it to expire out of the money, you'll take the delta value, subtract that from 1, and that'll give you the percent chance that your option is going to expire out of the money. And my go-to delta value whenever it comes to these options is a 0.2 to a 0.3. This means that there is a 20% to a 30% chance of these options expiring in the money, which means that you have a 70 to about an 80% chance of them expiring out of the money. And if you're right and your option expires out of the money, you get to collect all the credit that you received, and again, you get to keep holding on to the option that you bought, and then you can just rinse and repeat the strategy over and over again since you still own the call that you bought, basically owning 100 shares of the stock, and you can just continue to sell cover calls against it. That is, until you sell a poor man's cover call and then you get assigned on the option that you sold. Which brings me to the risks of the strategy. If the call that you sold expires in the money, then you're going to have to sell 100 shares of your stock. And you're probably thinking, Greg, I thought I didn't need any shares in order to trade this strategy. And you don't. If you remember from earlier, whenever we bought our first call, that gave us a right to buy 100 shares of a stock at the strike price that we chose. For example, if XYZ stock was trading around $100 whenever we opened our poor man's cover call and we bought a $90 call betting on it going up, but then we sold a $110 call assuming that XYZ will stay below $110 by our expiration date. If XYZ is trading above $110 by that expiration date on the option that we sold, we're going to have to sell 100 shares of XYZ stock at $110. But since we bought the $90 call from earlier, that gave us the right to buy 100 shares of XYZ at $90. Then we can use that to sell 100 shares at $110 because we got assigned on the $110 call since it expired in the money. And this means in this trade that we would make $2,000 from the difference between these two strike prices. The difference is $20 times 100 shares equals $2,000. And the great thing about this is since your trades balance themselves out, you're both buying and you're selling those 100 shares in the same trade basically, you don't have to put up any money in order to make this trade happen. This is going to be done by your broker if you have a margin account, which is probably required for the strategy because with any type of spread option, you need a margin account. Anyway, on this trade, we actually wouldn't make $2,000 in profit because we didn't account for the amount of money that we paid for the $90 call that we bought, and we didn't account for the credit that we received from selling the $110 call. So in order to come up with the profit that you would make from this trade, you would take the $2,000 from the difference between your two strike prices times 100. You would subtract the debit that you paid for the $90 call that you bought, and then you would add the credit that you received from selling the $110 call option. That will give you the amount of profit or loss that you would make on this trade overall. So for example, if we bought the $90 call for $1,000, we would take the $2,000 from the difference between the two strike prices times 100 minus $1,000 that we paid for the $90 call option would be $1,000, and then we would add the credit. So say we received $200 for selling the $110 call. In this trade, we would come away with a $1,200 profit. And here's a simple formula that you can remember this by. Take the difference between your two strike prices, multiply that by 100, subtract the debit that you paid for the option you're buying, the $90 call in this instance, and then add the credit that you received from the $110 call that we sold. This means that the difference between your two strike prices multiplied by 100 is less than the debit that you paid to buy your first option minus the credit that you got for your second option that you're selling. Then you would actually be at a loss in this scenario. So if the difference between our two strike prices was less than $12, we would actually come away with a loss on this trade. Another risk for the strategy is early assignment. And this basically works the same way as your option expiring in the money and having to sell 100 shares of stock at the strike price that you sold. Except it's going to happen before the expiration date because it's early assignment. So in order to mitigate this risk, you're just going to exercise the option that you bought early, of course, meaning that you're going to have to buy and sell 100 shares of your stock at your two separate strike prices, and your brokerage, again, is going to take care of this for you since the trade balances itself out. But that's not even the biggest risk whenever it comes to the strategy. The biggest risk comes from when the stock actually goes against you when the stock goes down. Since you bought a call option and that call option is relatively expensive, we paid $1,000 for that one earlier, we can lose $1,000 on that trade, but since we sold an option against it for $200, this mitigates our loss to some degree. We sold that for $200, so our total loss, if we didn't sell any more call options, would be $800. And losing $800 is a lot better than losing $1,000, but losing overall kind of sucks. The great thing about the strategy, though, is that you can rinse and repeat it. You can sell more cover calls after the other cover call that you sold expires out of the money. So if XYZ is below $110 on your expiration date, after that, then you can sell another call for the next month and just keep on rinsing and repeating the strategy over and over again in order to pay off the option that you bought. So if we kept selling call options against the $90 call, we could pay this off within about 5 months and this trade would be completely free. But again, you have to remember that you need the distance between your two strike prices to be greater than the debit that you received plus all the credits that you're receiving from selling these cover calls. And once you know this and you avoid it, you should make a profit. And to really drill the strategy down for you, let me take you through a real example. Alright, so the stock I'm going to be using for this video is going to be SPY, and I know it's very generic, but we'll get into the best stocks for this strategy later on. So we're going to go to the option chain, and we're going to find an expiration date about 6 months out or more, whatever you want. But I'm going to go with May 20th, 2022. And we're going to start out by buying a call option, top left. And then we want to search for an option with a 0.7 delta. So it has a 70% chance of expiring in the money. And this 440 call has a 0.6924 delta, so I would consider that close enough for us. So we're going to buy the 440 call, and then we're going to go back in the expiration date to December 17th, and then we're going to select sell a call against the 440 call that we're buying. And this 476 call has a 0.3 delta. So there's about a 30% chance of this option expiring in the money and a 70% chance of the option expiring out of the money to collect the $297 of credit that we would receive. So in total, we would be paying $3,864 for this trade, which actually isn't ideal because the distance between our two strike prices, 476 and 440, is $36. So you multiply that by 100, you get 3,600. So if our 476 call were to expire in the money to where we would get assigned to sell 100 shares of SPY 476, and we had to buy 100 shares at 440 by exercising the 440 call that we're buying, we would actually come away with about a $264 loss, which obviously you don't want to take a loss on this. And there's ways that you can go about rolling the strategy over, but ideally we would want SPY to be below $476 by our expiration date of December 17th. And if that's the case, we'll get to hold on to the 440 call that we bought and just continue to sell cover calls against it the next month after that, as long as they don't expire in the money and we don't get assigned to sell 100 shares at that strike price. So this really beats, owning 100 shares of SPY, which would cost you $47,000 right now. You can do this with $3,800 instead of $47,000, so it's a whole lot cheaper. And SPY isn't really a great example for this because it is sort of a more expensive stock. So here are the best stocks that you can use for the poor man's cover call. The best stocks for the strategy are going to be stocks that are going up. And you're probably thinking, well, duh, stocks go up. And they do, mostly, but there are trends that you have to look at whenever you're trading in the stock market, especially whenever it comes to options, because they are short-term by nature rather than holding 100 shares of a stock like you would with a regular cover call. And usually you'll want to base this trend off the past 6 to about 12 months of data, because usually this is how long you're going to be buying the call option for. This is probably going to be your expiration date for this call option. And some good stocks that have been in a good uptrend over the past 6 months to about a year would include AMD. I've always been a huge fan of AMD. I set a $150 price target back in April. We reached that recently. And AMD stock just seems to continue to be going up right now. Now, the direction of AMD could change literally at any minute, and then the trend would reverse, or maybe it would just trade flat, and then this would really no longer be a viable strategy. So you really have to pay attention to these trends and watch them pretty closely. But the next stock that I think is in a good uptrend right now would be Lucid Motors. Lucid ended up making their first deliveries a couple weeks ago, and their stock has been going up pretty much ever since. And you also have the federal government working on an EV tax credit, which is really going to help American EV makers and really help drive the value of their stocks up in the meantime. Now, I don't know when this EV bill is going to be passed. That's speculation. But I think that once it does get passed, then you might see a trend in the other direction, or you might just have a cool-off period where electric vehicle stocks just trade flat for a while. And finally, the last stock I want to talk about, which is another beloved EV maker, Tesla. And this is the top position in my portfolio with 19 shares of the stock right now. So I do have a little bit of bias behind it, but Tesla has been going up really, really quickly over the past couple of months since their earnings report. This earnings report really lit the fire and sent Tesla up to over $1 trillion market cap. Now, you can argue whether it's overvalued or not. I personally don't think so. I think that it's going to be one day the biggest company by market cap, but I think that the hype is really real behind the stock right now, and I think that it's going to continue to go up along with Lucid Motors until the EV tax credit has been passed. Now, obviously, I could be totally wrong about this EV tax credit, and electric vehicle stocks could do a whole lot of, but this is my thesis for right now, and these are some stocks that I would be using this strategy with. Whatever stock that you choose is going to be up to you, so find a stock that is solid, a stock that is in a solid uptrend, and use a strategy on that stock and hopefully make some profits out of this strategy. And I hope you learned something out of this video, and if you did, make sure to show some love, leave a like. Thanks for making it all the way to the end of this video, and thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.